Hey, good evening, everyone. Marty Missouri here. Sunday, the 12th of March, 2023, with a quick video for you. Some folks today had questions about the news that they were seeing and reading about Silicon Valley Bank. Let me just kind of paraphrase for you a back and forth text with a friend of mine. Question was, is the bank collapse in Silicon Valley the beginning of a larger issue or a one-off? This is from this morning. Too soon to tell how large an issue it is. It's definitely one the regulators can snuff out as early as tomorrow if it's politically feasible. It's not nearly a 2008 scenario from the perspective of bank balance sheets, yada yada. It is a concern if the regulators leave any ambiguity with regard to the protection of folks/companies who have more than $250,000 in cash in a given bank. That will cause a run on other small/local/regional banks. So could be a one-off, could be a few off, but of course the powers that be have had 15 years to ensure that backstops are in place to keep anything like 2008 from a banking sector perspective from happening again. My buddy, seems like such a surprise. It hit so quick with no warning signs, or at least not publicized. I said, yeah, what made them unique was that they were the bank for tech startups. A lot of funding has dried up for these companies, which began a bleed in terms of depositor withdrawals. On paper, the bank looked perfectly fine, and technically was, in parentheses, reserve requirements, etc., except for the fact that as they needed to generate liquidity as depositors were leaving, they were having to sell long-term bonds that were bid way down in price because interest rates have risen, and they did not hedge that risk. 3 exclamation points. Early last week, they announced that they were going to raise $2.5 billion in a new stock offering. That was the alarm that said they were in trouble, and therefore inspired depositors to begin fleeing en masse. So this evening, let me just tell you, the Dow futures are up 424 points. S&P up 1.77% in the futures market. NASDAQ 100 up 1.8. Russell 2000 up 2.8. Foreign stocks in the futures market are coming around. There's been some selling in Asia. Gold is up 1.2%. Silver's up 2%. Copper's up 1.6%. I could go on and on. Oil is kind of flat. Dollar's getting hammered. Again, if you didn't watch the economic update, I featured the dollar on that one, and I talked about how it's trading on yields right now. So what felt like a panic to some people, perhaps that would inspire a rise in the dollar, went the other direction because they think it inspires lower interest rates. The dollar is down 0.75%. That's a big move for the dollar. Crypto is exploding. Bitcoin is up 9%. Bonds were actually selling off noticeably. Now, I'm not sure. I don't know that this is the catalyst or was the catalyst. I've been on the road a lot of the afternoon and then this evening, but I did hear that Goldman Sachs actually predicts that the Fed is done raising interest rates, that they will not raise at the next meeting. And I was in a position where I could actually look at bond futures, and the 10-year yield went from green to red, meaning the price rallied. The 30-year is still up in yield 1%, which means the price has dropped. The 2-year Treasury yield is down 5%, down to 4.3. And that's a big decline, 23 basis points. That's a big move for the 2-year Treasury. It's a big move for any Treasury. And the 2-year correlates to the move in Fed funds, or the anticipated move in Fed funds. That's one of our indicators that we look at in terms of what the market thinks the Fed is going to do. So that is a massive drop there. So that would suggest that the Fed isn't going to be as tight as they were intending to be. Now, I will be happy to be wrong, but I think that the Goldman Sachs call is highly unlikely to occur. In fact, what happened today, by the way, is that the Fed essentially said depositors are going to get it all back, insured and beyond the $250,000 insured amount, both from Silicon Valley Bank and Signature Bank, which they also closed, by the way, this afternoon. But they will not bail out investors or creditors. Now, folks, this jives with this narrative that we've been talking about, going on more than 3 years now, or our long-term kind of structural thesis about how the world operates going forward. I went deep into those weeds, I think in the last 2 or 3 year-end letters, where we do a multi-part kind of a deep dive across multiple market topics, if you will. So I don't want to belabor that. I can get rambling on that and go on, but a labor-friendly regime, which we believe we've shifted into after a 40-year, call it capital-friendly regime. In a labor-friendly regime, as the name implies, the powers that be, and by the way, this is a global phenomenon, not a U.S.-only phenomenon. Call it populism. So when folks are in need, when the populace is in jeopardy, in that world, they will get a tremendous amount of support from fiscal authorities, from monetary authorities, what have you. So even though, this protection above $250,000, it still is considered a bailout of individuals, but not a bailing out of the executives of the bank, the investors in the bank, the creditors to the bank. In fact, during my drive, Bloomberg analyst came on and said, to be very, very clear, they're not bailing out investors. Now, I would say, of course they are. Absolutely they are. Not investors in Silicon Valley Bank, not investors in Signature Bank necessarily, but in all the other banks that could have seen a run on the bank, were forced to liquidate, like in Silicon Valley Bank's situation, say long-term treasury bonds at the market, and they bought them at rates that were probably close to zero. And now rates are a lot higher than that, meaning the value of those bonds in this marketplace is way lower. And essentially, what looks like a very strong institution, perhaps, suddenly is in huge hot water because everybody's leaving and they're having to liquidate. And perhaps at current market prices, they just don't have it, right? Silicon Valley Bank is that example. So there may have been other ones. Again, I don't think this was a system-wide thing. I didn't think so from the start. But certainly could be other smaller, regional banks that have a certain client base, like Silicon Valley did, that is maybe very industry-centric, right? Silicon Valley became the bank to tech startups, and they flee if indeed they're afraid that they're not completely covered just in terms of their deposits. Well, no doubt, if indeed, and I don't know that for sure, there were other banks that had the similar kind of risks. The government just bailed them out by bailing out the depositors, because the whole idea there is depositors don't abandon your bank, right? The notion that the Fed would cut interest rates or not raise them here really is an interesting notion. I would almost go the other direction, or at a minimum say they're going to stay right on track. Why? Because clearly we saw something break. By jumping in and doing what they did, essentially they take that risk off the table. That's certainly how the market is discounting it right here. And again, I'm not saying that risk is completely off the table, but that's the feeling at 8:17 Pacific time on Sunday, March 12th. In a world where we know that the powers that be are not going to let something like that break, is a world where we can just throw all caution to the wind and invest. Well, a world that has that kind of animal spirit underneath it, given all the other dynamics that we've written about and talked about for the last 3 years or so, is very, very inflationary. And the Fed keeps promising they're going to get to the 2% target. Now, this move today, or this action late last week and over the weekend in the banking space, speaks to what we talked about from the very beginning. This particular Fed, because of the underlying dynamics, U.S. government debt to GDP, the long duration of portfolios at very, very low interest rates and the potential risk there of a much higher interest rate environment. This Fed has massive constraints on their ability to aggressively raise interest rates. But at the same time, we've got this pernicious inflation that ultimately they're going to have to come to terms with at a higher structural rate than 2%. So they just keep throwing that out there. We're committed to our 2% target. We've maintained that if they're really committed to that, then we're going to get that recession that our indicators say is coming. And in retrospect, it's going to be blamed on the Fed for raising interest rates too much and tightening too much. Now, this event, and yes, clearly risk came to the fore, came to the surface with the Silicon Valley Bank, et cetera, situation. And it does show what tightening monetary policy does in an environment that was aided and abetted at a minimum by monetary policy. But policymakers just came in and said, hey, everybody's good. You would almost say that that gives them as much of a green light as they had before this thing came up to continue to raise interest rates, because we're not going to let something in the fixed income markets break and hurt real people. And by couching it that way, it's politically acceptable, perhaps, but in reality, as I already said, they really are bailing out investors and creditors in this event. So folks, I don't know that this really changes a whole lot. Certainly open to that idea, but it certainly doesn't help the inflation problem, which up until late last week was the central problem policymakers seem to be dealing with. At least that was the headline problem for sure. Okay, so enough rambling. Let's just a super quick look at the charts. I actually have gold up there. Since it's still there, I'll go ahead and look at it with you. Gold has a pretty bullish looking technical pattern right here. And clients, you know, gold is a not small position in our portfolio. So here you have it bouncing off of the 200-day moving average, recapturing here last week the 50-day moving average. And even down here, though, when we were testing this, we were doing it against bullish divergences on our two momentum indicators. So gold looks good. Now, if Goldman Sachs is right, gold probably will absolutely scream higher, because if the Fed is really done, that means real interest rates are going to go to the floor, meaning nominal rates, less inflation, right? So if you're going to keep interest rates relatively low and let inflation run hot, then you're going to have real interest rates that are negative, and that is a beautiful setup for gold. Now we're just going to take a look at the S&P and the VIX. So remember last week I said we're breaking down below that 50-day moving average, and below the downtrend line was not a good sign. And then on Friday, we went back, tried to come back and test it, and then ended up failing below. So were it not for the news that just occurred, I think 3,800 would have come swiftly. Like I said, I think that would have been supported by buyers. But, you know, we could have broken right through there. I did say that I was skeptical that this is the scenario that's going to lead to our ultimate bear market bottom. But, you know, it could have been. It could have been. Right now, unless something changes between now and the morning, we're going to get quite the bounce right here. And again, unless something changes. Now, remember that whole 0 day to expiration options action. Oh my, they must be gearing up, because when the cash session starts, if we get a massive wave of call buyers in there, that's going to make for an epic update tomorrow. If something else, you know, some other news headline, somebody backtracks a little bit on all this wonderful, you know, giving by government, and we go the other direction, well, the 0 DTE put buyers would come in, and we had that discussion about how dealers hedge. It works in both directions. And then remember, clearly with Thursday and Friday, I mean, the shorts did really well, and may have even gone further short because we had some technical room to fall still, right? And then if there were lots of put buyers that came in and the dealers had to short, there could be just a massive short covering rally in the morning to also exacerbate the upside. So tomorrow could be pretty special to the upside. Fundamentally, does it change anything? Not really. And we break up through these technical levels. Marginal new high right here would only come with some massive bearish divergences, and it would probably just be another bull trap that gets people sucked in only to get disappointed later. I've been showing the VIX a lot lately. We'll do that and I'll let you go. So the VIX, Remember last time it was very bullish pattern. We were pointing that out when it was sitting down here, and we got the bounce. On Thursday, we were looking at this massive candle. I drew one of these lines up here, and I said, wow, if we can break through and get a marginal new high, this thing is off to the races, which would be very, very bad news for stocks. So you can see on Friday the massive range here in the VIX. Were it not for the news this evening, it could have been pretty ugly going into tomorrow. And again, still could be, but right now it certainly doesn't look that way. Again, if all this evening continues into tomorrow, and we'll get back down and we'll move into this range in here, and we'll see. We'll look at this again and in the midweek update here in a couple days. So folks, I'll just leave it there. Thanks as always for watching and listening. Take care. Bye-bye.